Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's a gold stock fund manager, and he also co-founded the Bitcoin Opportunity Fund. He runs Equity Management Associates, LLC. Lawrence Lepard, thank you for joining me again.
Hey, nice to be with you, Jason. I always enjoy our conversations.
Me too. You're actually one of my favorite people to talk to. We should definitely talk every couple months and keep the dialogue going, considering you're one of the few people that actually is open to both Bitcoin and gold and silver.
Yeah, yeah, I love them both for different reasons, and we all know the pluses and minuses of both.
Yeah, I mean it's getting ridiculous here. Like the Bitcoin crowd and the gold crowd, like they're just screaming at each other. I try to ignore that.
Some are and some aren't. I think more and more people are coming around. I mean, we're all on the same team, and we all see the same problem. And what's interesting to me is I see more and more gold people becoming Bitcoiners, and I would expect that over time. So it's all good.
I think diversification is important because you don't know what's going to happen in this crazy world with all the political rules changes. I mean, who would have thought that like an election could change so many different variables? Look at what's happening in Latin America. We'll talk about later in the interview with these elections the last 6 months, whether it's Colombia, Mexico, Chile, Peru. Looks like potentially we could have open pit mining licenses either delayed or totally withheld in some of these countries.
Yeah, Mexico's a bit of an issue, but I have some views on that. So.
Okay, well, first let's talk about the macro picture. Are you surprised, given all the macro conditions, that the Fed hasn't started to cut rates yet, that the dollar index was relatively strong until the last week or two, that the gold price has still stayed above 1,500 for the last 4 or 5 months?
No, I mean, I guess, I'm not terribly surprised by any of those things. I think the Fed I mean, obviously they've indicated, Powell just said he's going to cut rates in September. So we know that's coming, whether it's 25 or 50, we don't know. The odds are now saying 67%, 25 and the balance at 50. The gold price staying high. I mean, I think what the gold price is reacting to, and I put this in one of my Twitter tweets, was that I think the gold price sees all the chaos out there and realizes that they're going to have to print. And so gold is always pretty good at sniffing out debasement before it occurs. It did it back in 2018, 19. It did it in 2016. And the Bitcoin price has kind of been stuck in a channel, but gold is up at record highs over 2,500, as you know. And to me, that's not unusual for gold to kind of move first. Bitcoin tends to follow it, maybe harder, but later. They're trapped, right? They cannot continue to have high interest rates because, the government, the fiscal dominance of the government's facing, which is to say the deficits that they're facing and growing, are driven by the size of the debt, which, I mean, I just saw today it grew another, I don't know, X billion in one day. And I multiplied that times 365, and it was a scary number. It was just, billions and trillions of dollars. So, they're trapped, and it doesn't surprise me that they're going to cut rates. And I think this is just the beginning of the rate cutting cycle. I think that, you're probably familiar, and your listeners are probably familiar with this thing called the Psalm rule, which basically says that if the unemployment goes up 50 basis points off of its low, in almost every, and this is Claudius Psalm, was a Fed economist who figured out this rule. In almost every instance where that occurs, you ultimately have a recession. And so it's, because of all the money that was printed and all the stimulus that's been given, they've held off this recession. I would have thought it would have happened a year ago or more, but they've kind of held it off. But I think it's coming. It feels to me like it's coming.
And I think the demand side for physical gold, it's coming out of the new supply of demand, like the marginal increases in demand. We've had this constant increase of dollar cost averaging by non-G7 central banks really since the Russia sanctions over the last 2+ years. So the amount of dollar cost averaging each month has increased. It's almost doubled, I think, each month. But really, the increase in demand, Lawrence, has been since October 2023. We've just seen an explosion, I would call it, of retail investor demand for coins and bars out of Asia. So China, India, Japan, Korea, Vietnam, Thailand. That demand has been very constant. And when the gold price drops below $2,500 an ounce, it seems the bid has started to come in. We saw that again recently. The new demand numbers for China gold imports for gold coins and bars from Hong Kong to the mainland China is up another 17% for July 2024, according to the latest data.
Well, that's interesting. I had not seen that data, but it doesn't surprise me. And there's a lot of demand here too. I mean, I had in one of my recent newsletters how Costco is, they put bars up and they sell out immediately. But the ETF demand in the U.S. has actually been declining. The size of the gold ETFs in the U.S. have been going down. And I think that's because the ETF buyers or the stock account buyers, I mean, there's a lot of people still believe in the U.S. stock market. And so they're invested there. And then to the degree that people are going to sound money, they may be buying the Bitcoin ETFs, which have just exploded in size and obviously probably taken away a bit of the gold demand. But yes, I mean, when the U.S. sanctioned Russia and grabbed their 600 billion of assets and behaved in a way that kind of said to the world, hey, your money isn't safe here. We've seen a very obvious trend to all of these non-Western countries or Asian countries starting to trade in their own currencies and net settle in gold if they have to. And so, and the dollar, to me, the dollar is a very interesting story. I mean, it's sitting right at a level where it's not going to take much. It's kind of, you draw a line on where the dollar is right now, and it's not going to take much, and it's going to break down hard. And
Are
that
you
will,
talking about the dollar index, or are you referring to something else?
yeah, no, I'm talking about the dollar index, USDX at DXY. There's if you look at it, I mean, it's kind of right now I've got it at 101, but and there's kind of a shelf there for for the past, I don't know, 6 months or so, 6, 8 months. And my sense is that, with this easing cycle, the dollar's going to fall hard, and that's very bullish for gold and silver.
And Japan spent, I think, over $100 billion selling U.S. treasuries to defend their currency exchange rate, the Japanese yen against the dollar, and it hasn't really worked very well. I think it worked for maybe a week or two with that much of their foreign exchange reserve spent. They've been talking about continuing to raise interest rates. They can't afford to raise interest rates. But Lawrence, in terms of financial history, when a country wants to defend their currency, I mean, I think adding gold tonnage is a smarter long-term play than raising interest rates.
I completely agree. I completely agree. And I don't know if Japan is increasing their gold holdings. I don't think they are, but
They won't. They won't
yeah,
because they won't post World War II. I mean, they're in the G7, so like they have those deals signed with like the Federal Reserve Bank for like bailout funds for their banks, like with the currency swap lines and the other stuff, the G7 agreements. So post World War II, Japan's like a vassal state. I don't unless they want to, just basically divorce themselves from Washington D.C. and no bailouts or helps for their bank or anything like that, or no military help. I don't think they'll start buying gold tonnage.
kind of tend to agree with you. And I'm looking at the chart of the Japanese yen US dollar cross, and yeah, I mean, it's stunning what happened with the yen. I mean, it fell from 160 to 140, or I'm sorry, it rallied from 160 to the dollar to 140 to the dollar, and and then they intervened to try and prevent that, and of course, it's right back down to where it was. So they've got a real problem over there, and this is just one of the many rivets that I kind of see, popping out there in the world. I mean, commercial real estate's another one. We've talked about that. And, they've, the U.S. stock market really is the entire game right now. And it's a big question mark in my mind. There are those who think that these rate cuts will drive it on to new higher highs. But my view is actually no, we've topped and we're in the slow but steady process of rolling over. This kind of reminds me of the summer of 2000. The peak in that cycle was in March, and that summer it rolled over. It wasn't until 2001 things really started to go down hard. It also has a little bit of a reminds me a little bit of kind of the '08 period, the summer of '08 period. And, we'll see what happens. But it strikes me that the Fed is going to have their hands full. And I think they are going to be cutting rates rather quickly once these problems in these other markets get more severe. They're going to realize they have to, and they're gonna claim that inflation is under control and contained. And certainly it's come down from the boil of 9%, but it's still in the high twos, low threes, depending on which measure you use. And that's a ways away from the 2% goal. And to me, it's only a matter of time before we see the next upswing in inflation as a result of the Fed easing. So we kind of know what's coming, but it's always been a case of you don't know exactly when. And that's that makes, from an investor point of view, that makes it hard. You don't want to get blown out on the swings, and these things can be very volatile. I mean, you look at the S&P, for example. I mean, it took one hell of a dip, right, in on this Japan thing. I mean, and then it came right back. I mean, where did it go from 560, 5670 down to 5205? It was a pretty good sized dip, in July. But they brought it right back. I mean, the Fed put is very much alive, right?
Well, margin calls. I think like you had the yen carry trade margin calls, and that carried over into the leverage short volatility margin calls because the VIX was basically dead. It was stuck around 12 to 16
Right.
range for many, many months. And then the VIX spiked to what? Did it get to over 60 briefly? It
Yeah,
was in
It was stunning. It was absolutely stunning to me how it ran really hard. I mean, kind of, 2020 or 2008 like in terms of its run, and amazingly they've kind of put it back in the can. I mean, I think they and
Well,
I
they
think
have to, or you're looking at like bank failures and hedge fund failures. Because I mean, things are at least that leverage short volatility trade that Christopher Cole used to cover when he was managing money, his volatility hedge fund, the pension funds pulled the money out like 18 months ago. I mean, he was saying it was 3 trillion in size. That was like 2018 or 2019. So it's a
right,
very large income trade for Wall Street for the institutional investors. They sell volatility.
correct. Yeah, no, it's yeah, I mean, in the basis trade, I mean, there's all, look, I mean, I don't think people can see it because it's pretty well hidden. But I think there's leverage and implied, volatility everywhere that at some point is going to maybe, run them over. I mean, my guess is when the whole Japan thing happened, I'm sure, that the Fed was, issuing swap money to Japan. I mean, all these guys coordinate it, right? And they're all in the same boat. All these
Oh,
central,
I agree. Yeah.
exact
Well,
same.
well, did
They know
Janet
they've got
Yellen?
problems,
Well, look at Janet Yellen. Didn't she? She went to Tokyo. She went to Japan right after her China visit earlier this year. So I think that was what was discussed. I think they realized that the Fed keeping rates that high and the Silicon Valley Bank treasury losses, that was going to happen to the Japanese yen and the Japanese banks. And then within a couple months, you saw problems with what Norinchukin Bank, the fifth largest Japanese bank.
Correct.
From what I spoke to another hedge fund manager, Nancy Davis, my listeners can go back and listen to the archive. She went through the Treasury disclosures, the Fed disclosures. She checks that because she's a hedge fund manager and she runs a bond volatility fund. She was telling me that like it was disclosed that Norinchukin Bank got a separate swap line or reverse repo line from directly from Treasury and the Fed. That's how bad things were.
Wow, that's interesting data. I was not aware of that. But honestly, it does not surprise me, right? As I'm sure it does not surprise you. Yeah, they
all,
look.
all these plates are spinning, right? The analogy is
Yeah,
what all these
exactly.
plates are spinning and they're trying to keep everything in juggling, all the balls
That's
juggling in
that's
the
that's the perfect metaphor. And we know that behind the scenes, they've got a printer and they're going to use it, right? I mean, it took us a while. I was around when 2008 went down, and I'm writing a book actually. I'm talking about that, and so I just revisited the numbers, and it took Bernie Sanders with his Freedom of Information Act request to find out how much money the Fed sprayed around. But when 2008 occurred, the Fed let out $16 trillion of swap lines, 16 trillion at a time when the GDP back then was like 8 trillion. So now they pulled it back in as everything got calmed down. But my point is that when they see problems in the system, they just print money and send it wherever it's needed to calm things down because
exactly, exactly.
they have to. And we're seeing M2 is slowly but surely growing again, and China's been printing like crazy. So if you look at global M2, it looks like it's kind of broken out. And I mean, this is a case of what Richard Russell used to call inflate or die.
Is
They,
M2 growing? Is that in the private sector banking, the commercial banking system?
I think so. Yeah, I think that's right. I think some of it, Lynn Alden explained it to me and said that a piece of it is actually the reverse repo stuff running down leads to M2 growth. To be honest with you, I mean, it gets pretty damn technical and tough to follow, all the moving pieces in in the monetary system. I mean, but I think Lynn does as good a job of that as anybody, and so I listen to her.
Yeah, so I'm wondering what the banks, because the banks aren't loaning that the funds then if they're growing the money supply with fractional reserve banking, fractional reserve loans, they're not loaning it to Main Street businesses, small businesses, commercial real estate, a lot of that stuff. I mean, those things do not look in good shape right now. So I guess maybe they're loaning it to the US government for new treasuries. They're buying the new treasuries and helping to monetize the debt
I
and
think
stuffing
that's
it. Hmm?
I think there's a spread trade there. I mean, as you know, in 2008 they changed the rules so they could get interest on excess reserves, which is, by the way, why so many of us had it wrong in 2008. I mean, in 2008 I thought it was all over and we were going to have massive inflation, and we didn't. And the reason we didn't is that they were able to bottle up the money they printed by paying the banks big reserves, which is really just a subsidy to the banks. I mean, this
Well, and
whole thing
they
has
also funneled they directed the monetary, not only they sterilized some of it, right, and they were paying enormous interest on excess reserves, they also funneled it into like the derivatives market, into the stock market, into the real estate market. They funneled it into mostly asset markets with the Cantillon effect. So that's how they kept it from like
that's
crazy stagflation in the real economy with Main Street.
exactly right. I mean, they basically, as you and I both know, they basically blew quote unquote the everything bubble in the sovereign currency, as opposed to, a commodity and CPI bubble. They were able to keep that stuff under control. And they also did a coordinated attack on gold in 2013 where, you probably remember that event. I mean, they managed to shove it down several $100s in a matter of a week, right after Goldman Sachs told all their customers to short it. I mean, it was very obviously a coordinated attack. And so, yeah, I mean, they have this thing called the Exchange Stabilization Fund. You can Google it, you can see it. There's, $30 trillion in there, or billion dollars in there. I mean, look, the Fed, these markets are Franken markets. They're not real markets. And they're very much aware that unless they keep these markets going up, this whole thing's going to implode. Which is why, I mean, I kind of think we probably put in a top in the stock market right here. But I'm actually somewhat sympathetic to this guy. And I don't know if you've ever interviewed him, but there's a smart guy named David Hunter on the web and on Twitter, and ex-Fidelity money manager. And his view is, we're going to blow off. We're going to have a real blow off top. The S&P is going to, 7,000 plus before it totally rolls over. And for all I know, he could be right. I just
Well, it depends what the other central banks do. If we're going to, because we're already seeing this, what with the Bank of England, the European Central Bank, they're claiming that inflation is what 1% or barely above 1% in those other countries. Oh, we have inflation tamed. We've killed inflation. It's under control. We're going to start cutting interest rates. We're going to start adding liquidity back to the system. Well, it just seems, Lawrence, that the liquidity that these other central banks added ends up here in the United States in our stock market or in home prices or other asset markets.
I think that's a part of it. And, again, the other thing, of course, we've got to touch upon is just, the reported inflation figures are just totally bogus, right?
Yeah.
I mean, X food and energy, which are the things that you really live on, which are the things which you care about inflation. I mean, I tweeted it recently last month or so. I mean, my homeowner's insurance on a house I own went up 100% year over year. My auto insurance is up 20 or 30%. I mean, these numbers are very much larger than two or three or even nine. So, and I think most consumers and most people in this country, I mean, you tell them inflation is 3%, they don't believe it. I know I don't believe it. So, and as you know, John Williams, shadow government stats, and the Chapman index. I mean, there are a lot of things that show that inflation is running much higher than they say it's running.
Oh, you're
But
talking about the Chapwood Inflation Index by Ed Batowski?
yeah, exactly. Yep.
Yeah, I mean, for listeners out there who are not familiar, so everyone's talking about like trueflation right now. That's similar to the MIT Billion Prices Project, and I don't
Yes.
think so. I think the trueflation number, it says that the real inflation rate has been around 25% the last 3 or 4 years, but they're not accounting for like shrinkflation and some of the other stuff that food companies and restaurants and grocery stores will do to kind of save like their profit margin. So that's not accounting for cost per unit accurately. I would say that like for our listeners out there in the archives, I interviewed Ed Batowski once, I think like 7 or 8 years ago. He got attacked, and I think he had to shut down. He got political attacks online because I think he came out and endorsed Trump before the election the first time, and he had to shut down his social media for a while. I'm not sure if he's back online, but he talked about his methodology during the interview with John Williams of Shadow Stats, and basically like he had long conversations with John Williams, and then he went and tried to do an even more in-depth index in major cities, so like San Francisco area, Dallas area where he is, New York City, Washington D.C. metro area, and tried to monitor about 500 consumer staple prices that people tend to buy like every like few months or something.
Right.
Yeah,
Yeah.
and his numbers are way higher, I think, than the shadow stats. They've been substantially higher than the shadow stats for the last 10 or 15 years.
Yeah. Well, and even the shadow stats numbers are way higher than the CPI. I mean, honestly, I mean, the measure of inflation that I use, over very long periods of time. I mean, I'm writing about this in my book. It's just M2 growth. I mean, M2 growth is the base money, the widest money supply that we keep track of right now. And from 71 to present, it's grown at kind of 7 point something percent per year. And so, even though we've had years with reported inflation that's lower than that, to me, that's just embedded inflation that comes out in the future. And I
Seven
kind of
percent stagflation. So that's what that means. Then if the stock market's being, I think the stock market's grown. The S&P 500 hasn't it grown about 8%, 10% per year. So it's keeping track. The
that's
M2.
that's in my book as well. So, and gold, by the way, so from let's just take the period from 71 to present, okay, 50 some odd years. The compound growth rate in the M2 is, I think, in the mid sevens. I'm just going to say 7.5 off the top of my head. The compound growth rate of the S&P index is actually a tad less than that. It's in the well, it's closer. It's in the mid sevens as well. The compound growth rate of the price of gold from 35 to today's price is actually 8. But where stocks beat gold is if you take the untaxed dividend yield on the stocks and add that. If you had it in an IRA account and you reinvested all the dividends, the stock market from 71 to present has gone up about 10% a year. So it's slightly outperformed gold and it's slightly outperformed inflation. But
And then you add in capital gains tax in addition to the
well,
inflation tax, and then
that's
the government's stealing even more of your assets.
well, that's the thing. I mean, and by the way, most people don't have untaxed dividends. I mean, they have dividends, they have to pay tax on them. So yeah, look, you have to own assets, and the Fed has forced everyone to become gamblers slash investors slash asset owners, because if you don't, you're just getting eaten alive. And I talk about this in my book that I'm working on. I think one of the things I think people fail to focus on is when '08 occurred. You had this big crash, and they came in with all this money and they printed a ton of money, and they kept inflation under control. But another factor that most people don't really consider is that pre '08, there were a lot of people in their 60s, 70s, and 80s, and I know some of these people who had worked their entire lives to save between half a million or $1 million, whatever it might be, and they could safely put their money in a bank CD and earn 5 or 6% a year. So if you'd worked your whole life, your house is paid for, you had $1 million, say, of savings, which you might have if you worked your entire life. You put it in a CD, you get 6% a year. That's 60 grand. You collect maybe 20 grand in Social Security. You live modestly. You can get by, right? You're okay. But what happened? Well, so along comes the GFC. Bernanke does all his nonsense. They take interest rates to zero, and CD yields go to zero. So, that 75 or 80-year-old who was counting on that CD income was suddenly forced, to buy into the stock market, which had just gone down 50%. And it's effectively become a gambler, a stock gambler. And so it's just
Just to
very,
get income, just to get income, right?
just
So
to get income. Yeah, it's just very wrong. It's just very, very wrong. And I can't tell you how frustrated I am with the system we have and with the Fed and everything else. And that's what the book is about, that we just got to eliminate the Fed. I mean, the Fed has caused so much misery and pain for people throughout this country for, decades, decades. And I talk about how it hurt my father. He was damaged by the 20% interest rates in 1980. I talk about how it even hurt my grandfather, who was running a business in the 20s, and he got the wrong pricing signals, and so he expanded. He uses debt to expand, and then, of course, when the collapse came in '29, he had all the debt, and the business went down. And he made it, but it was pretty hairy, right? And so, I mean, these kinds of swings in interest rates, prices, economy, all of this. I mean, they've gotten exponentially worse since the Fed has been in place. And I've got a great chart in my book that shows that. So.
I have a great anecdotal story about that too. When I was working my day job as an investment analyst at Junior One, working my way up at a paid newsletter company. So I got stuck on customer service phone calls, and I wasn't even working on the dividend stock growth paid newsletters. And I had to deal with an angry customer, and all of the newsletters had in all capital letters at the bottom of every page an entire paragraph saying, in the model portfolio, do not put all of your life savings into 5 stocks or less. This guy calls up, he's retired. I don't know exactly his age, but he seemed above age 65. He's talking about he put $500,000 of his retirement nest egg, excuse me. He put almost all of it into 1 or 2 dividend stocks in the dividend stock growth portfolio. And I think it might have been Kinder Morgan or one of those. And they had cut the dividend by 30 or 40%, something like that, slashed it, because they were changing from a master limited partnership to a C corporation. And I was like, I'm really sorry to hear that, but there's a disclaimer on every single page in all capital letters of the newsletter saying not to do that. He was like, but I needed the income. And
Right.
he's like, but I needed the income to live off of. I needed that 8% or 10% dividend yield on my 500,000, 400 or $500,000 to live off of. And I was like, well, you could have diversified it a little smarter rather than betting it on one stock.
Well, that's right. But again, I mean, he's probably just the person I've described, right? I mean, pre that '08 event.
That was 2013. Yeah, that was 2013 when I think Janet Yellen had just taken over for Bernanke.
Right. I mean, but that gentleman could have put his money in CDs and gotten 6%, safely with zero risk. Pre, this crazy monetary policy that these guys established. I mean, I don't think the average American really fully understands just how damaging and crazy going to zero interest rate, ZIRP, zero interest rate policy was. I mean, it's a tautology. I mean, the whole notion that money should have no yield, that money should be free, which is kind of what the Fed says when they take the interest rates to zero. Well, okay, if money has no yield, then money is worthless, right? Which, of course, you and I both believe fiat money is worthless. But the point is, it was an extreme. It was incredible
Well,
extreme. And
I think they I
I
think
remember,
they did it, Lawrence, to save the banks because
of course,
what they eliminated the reserve ratios, right? Citibank had
yes,
100 to 1 leverage in
of course,
2008 because they were insolvent. So they changed the accounting laws. They went to zero, right, to save the
right?
banks and to save the government and the large corporations
Yeah,
initially
well,
with Bell.
FASB 156 changed as well, and so that they could basically, mark to myth. Remember that?
Yes, yes. March 2009, yes.
Yeah, exactly. I mean, so yes, I mean, this is all in service of saving the banks. But meanwhile, if you're just a citizen trying to live your life, trying to plan your life financially, you have to live with these bubbles and bursts. I mean, look, everybody who chased the dot-com bubble, the stock market went down 50%. And then of course it repeated that in '08, went down 50%. And in both cases, the yields went away because the Fed printed so much money and dropped rates to zero. I mean, and what really bothers me, I remember Bernanke's testimony at the time, and he was saying, "Well, yeah, because some congressman asked him this question, said, 'Look, I've got constituents who used to have CD yields, and because you've done this, they don't have CD yields.'" And he was like, "Yeah, but they'll be better off because the economy will be better off." And I'm like, "Huh? How does that work, dude?"
Bernanke also wrote a white paper that there is no inflation if central banks all take relative turns evaluating, if they either take relative turns coordinating or they all print at the same time. Then he wrote a white paper in theory how relative price levels would not be affected if all the central banks either coordinated their actions or all did monetary inflation and quantitative easing at the same time. So basically, this is a lab experiment. This is why I argue, Lawrence, that post 2008, the entire system went full debt-based fiat currency and credit Ponzi scheme.
Yep. No, you're absolutely right. And it's only gotten worse. And as I say, I thought 2008 was the end of the whole game, but no, they managed to blow it. I mean, that was a housing bubble. Now they've blown a sovereign currency bubble, and there's no level above this. It's not like we're gonna go to Mars and there's a bubble that's bigger than this. When you've got a bubble in your sovereign currency, that's it. It's over, and the currency is doomed. Which is, as I know you believe, I do too. The purchasing power of this currency, as it's currently constituent set up, is doomed. It's
Well,
just
I also think because of all the dollar denominated debt that was taken on when the dollar was weak, when interest rates were low, when the Fed strengthened the dollar by rapidly raising interest rates, what in 2021 and 2022, I also think it started to break foreign banks that were holding those old treasuries that had the dollar denominated debt that had
exactly.
given out the hedge funds these leverage trades and stuff. So I think we're starting to see that now that like these Japanese banks, they loaned out, they were the lenders of the yen carry trade and older treasury bonds. That Norinchukin bank that we talked about earlier, they became a market maker, Lawrence, for collateralized loan obligations and commercial real estate in the United States. I mean, they have a ton of like crazy derivatives exposure that the fifth largest bank in Japan, honestly, should never have.
Yeah, no, I get it. I mean, yeah, you're right. I mean, I completely agree. You're right. I mean, it's amazing the way they, all of these banks, central banks, collude to keep this game going. And, for now, they've been able to do it. So, I mean, I have to tip my hat to them. I mean, I've underestimated them all along the way. And I know there are people who think, well, they're going to just continue to be able to pull it off forever. But I differ on that view. I think that it's getting large enough and obvious enough to too many people. And to me, what will happen here is we're going to have another event, and they're going to have to come back, and the Fed balance sheet is going to go from 7 trillion to 20 trillion.
Yep.
And eventually, as you know, hyperinflations or very high rates of inflation occur when everybody who, is looking at the system says, "Oh my God, they can never stop printing." And I mean, I've certainly come to that conclusion. I think you've probably come to that conclusion. I think others are joining us, but there's still a large part of the world that thinks, oh, they've got it under control. We'll go back to low inflation. And this was just all driven by the pandemic. It's a one-time thing, blah, blah, blah. I get all of that, but then I look at the trend in long-term, the U.S. 10-year Treasury rate. There's a great chart that Ronnie Stofferle's group put out that just showed, kind of a long-term downtrend the upper line boundary of that chart got broken in 2020. And I think we now live in an inflationary world, and they're going to have a very hard time getting this under control.
Well, I think the main issue is the supply and demand imbalance from US Treasuries, and a lot of it's because of DC spending from both political parties. I mean, the
Right.
fiscal 2025 budget projection spending, we're over $8 trillion. And I don't think they're accurately accounting for interest payments on the rapidly growing national debt on that number. If Trump wins the next election here in November, it's looking like there could be trillions more spent for Cold War 2.0 spending to update the military industrial complex to compete with Russia and China. There's all these research reports coming out saying that I've seen estimates between 2 trillion and 10 trillion need to be spent on military spending to compete with military technology from Russia and China. So it's just neither political party, Lawrence, seems interested at all in wanting to balance a budget or cut spending.
I think that's absolutely right. And I think until the markets punish them, they're not going to change. I mean, I think the only thing that would cause that to change would be, a market event that is just so large and so devastating that they would be forced to have no choice. And, so I mean, as you and I both know, the easiest way out for them is inflation. I mean, it's, they can claim they're fighting it and they can say they don't want it, but the fact of the matter is they absolutely do want it and they absolutely have to have it, or else the whole thing's it's a house of cards, it's gonna collapse. And so, that this all supports the David Hunter thesis that we actually, the S&P is gonna blow off some new higher high. I mean, I know that if
Is that
I
a crack up boom or a melt up scenario
well,
then, where
yeah,
like on a relative basis the dollar doesn't collapse, but everyone can tell that there's way more monetary inflation and currency debasement than the government's claiming?
correct. And I when you say the dollar doesn't collapse, I mean the stock market doesn't necessarily collapse, and maybe even the dollar index doesn't collapse because the other fiat currencies are bad. But one of the big clues that I look at, and I'm sure you do too, is the price of gold and the price of Bitcoin, because these are the two canaries, right? That talk about, I mean, Brent's got a great theory with the dollar milkshake theory, and he's right. It was the reserve currency, still is for, but losing ground. And it's better than the other fiats, because of that status. But that's not the cross that matters. The cross that matters is, and it's easy to spend, and it's definitely the best medium of exchange because everyone takes dollars. The cross that matters is the price of gold and the price of Bitcoin, because these are currencies that are not government owned, government controlled, government printed, and they both have, monetary policies built into them where they just don't, the supply doesn't grow that fast. In the case of Bitcoin, it's growing quite slowly, and that's diminishing over time, and it has a cap. And in the case of gold, that we're only mining 1.7% of the outstanding stock every year. So, and that's getting harder and harder to do because big discoveries are going down and grades are going down and so on and so forth. So, to me, those are the two warning signs. But yes, we could have very much be in I wouldn't call it a full-fledged crack-up boom. I think it's kind of a mini crack-up boom. And, one of the things people have asked me, say, do you see the possibility of hyperinflation in the United States? And the answer is no. I mean, it's not a high probability event given, our size and all the things we have going for us. But it's not a zero probability event. I think the mainstream people would say, oh, it's absolutely zero probability. And I disagree. So, if Kamala, heaven forbid, if Kamala were to win and the Democrats were to get control of the Senate and Congress and they were to start really ramping up the social programs and universal basic income and spending on this, that, and the other thing, and the deficits went from a couple trillion a year to 4 or 5 trillion a year, that will lead to very high inflation. And then, as we all know, very high inflation is a precursor to hyperinflation, right?
Well, I think we've already had clear stagflation way above the consumer price index because the height of the consumer price index claims it was only 9% inflation rate. I mean, Lawrence, my purchasing power losses the last 4 or 5 years since 2019, 2020, I would say my purchasing power has declined by about 40 or 50% on my everyday living expenses,
That's how
at
it feels.
least.
That's exactly how it feels to me too. I think when I did the math on the COVID print, and when I look at that carefully, I mean, I think they kind of devalued our lives by about 40%. The cost of everything we're spending money on has gone up roughly 40%, or the wealth that we hold buys 40% less, in terms of underlying assets. And it's just
And
dreadful.
those are basic things for like a normal life. So like rent, mortgage payments, food, utility bill,
It's
gasoline in the car, insurance costs. Those are just healthcare insurance. Those are just normal stuff.
Yeah, correct. Correct. It's absolutely horrible. And you've got, Jay Powell out at Jackson Hole joking about, the good ship transitory being crowded, like making fun of the fact that they blew the call. I mean, and these people just, I mean, he's worth $100 million. It doesn't matter to him. But, for the average person who's, working a regular job and trying to feed their family and keep them clothed and everything. I mean, it's horrible. It's absolutely horrible. I mean, and I
Stagflate tax lie. And at least though he called out the government, the Bureau of Labor Statistics, the White House for lying about the jobs report. So that's the one good thing Powell's done recently.
I actually missed that, but yeah, if you say so, I believe you. I missed that. I mean, yeah, I mean, that's the other thing. He's trying to base his decisions on data, and when the data is, blatantly wrong, I mean, they misestimated the job numbers by what, 800,000? I mean, look, I mean, it's amazing. I mean, the Fed has like 300 PhD economists on its staff. I mean, what do they need those people for? Those people don't have a clue what they're doing, you know.
I think it's more than that. I think there's thousands. I think there's a couple hundred maybe at each of the Federal Reserve Bank locations. At one, I think I heard, Lawrence, I'm not sure if this is accurate, but I think I saw somewhere over the last few years that their annual research budget that they pay for like research grants for the PhD economists at universities and at each Federal Reserve Bank location, they're paying like $8 billion a year to these PhD economists for research budget. Yeah, for grants and
That
stuff.
sounds high to me. I've got a really good article, and it's going to be referenced in my book. That talks about how the Fed has bought the economics profession, and they control all the economic journals. And so if you're, one of the things I find interesting, right? You and I both know that the Austrian economists have the right model. And yet, there aren't very many Austrian economists in this country because, as an academic, if you're an Austrian economist, you're not going to get tenure, you're not going to get published in the journals, you're not going to get invited to Jackson Hole, et cetera, et cetera. And there's a great article that I reference in my book. It talks about, it was in the Huffington Post. It was quite some time ago now, but at that time, this was 08 or 09, I think it was 09, Huffington Post estimated the Fed spent $380 million a year on economic research, more or less paying, academics and economists to do papers. And of course, as you can imagine, those papers are heavily weighted towards supporting the Fed and the Fed's policies and Keynesianism and all that stuff. I mean, the article was brilliant because it talked about how some people had said, well, from time to time, we've tried to challenge the orthodoxy. And if that happens, I mean, you just kind of get blackballed. You don't get invited to the conferences. You're not going to get tenure. The
Big
academic,
pharma,
yeah,
it's a revolving door of corruption, right? Because if you go into the government as a PhD economist, let's say you work as a PhD economist in Washington, D.C. metro area, then you could get a job at Wall Street, then you could get a consulting gig at a hedge fund. And that's how like Janet Yellen and and Ben Bernanke and some of these other PhD economists end up with like, we're being worth over $10 million and all these government pensions and private sector pensions and
oh,
consulting gigs.
that's absolutely right. So it's like so many other things, it's just absolute corruption. It's just absolute corruption. And
Big
there's
Pharma does the exact same shit, my friend.
yes, I was
So
gonna
does the
say,
military industrial. You
yeah,
would be
but
shocked.
so does Big Food, by the way. I mean, they all, they all get these studies and things that support the position of the companies that are going to make money off of that position, right?
Oh yeah, the food pyramid. Yeah, RFK Jr. has been talking about that and others. Yeah,
I,
big food. Yeah.
I remember that guy. I mean, there's a Harvard guy who created the food pyramid that basically said we should stop eating fat and protein and we should eat carbs. Well, how's that worked out? 40,
Diabetes explosion. Look,
40% of the country's obese. I mean, but they're selling a lot of Ozempic. I mean, there's a bright side from the drug manufacturer's point of view, right?
I'm shaking my head here. You don't see it on video, but I'm just shaking my head. I mean, it's good for big pharma and it's bad for almost everyone else. Lawrence, I want to ask you, I want to transition now to gold
Yeah,
miners because we've talked a lot about the macro picture and the corruption. Yeah, and I don't think they're going to allow deflation for a long period of time. I see more accounting rules changes, manipulation, maybe hidden bailouts. If things get bad, they'll issue press releases and say, okay, this bank is getting a currency swap line or some type of bailout, and that's how they'll juice the system back.
I
But I
think
want to.
I think that's right. I agree.
Yeah, so I don't see deflation for a long period of time because, like, look, even a couple weeks ago, that VIX spike, right? I'm sure they were panicking. The hedge funds and the banks that had the leverage short vol, I'm sure they were getting margin calls if the VIX would have stayed above 30 for a long period of time. I mean, that's potentially large hedge funds or banks failing.
Correct. Yeah, no, that's correct. So you want to go to the gold miners? I mean, yeah, the gold miners still haven't really had much love or much joy. There's a big run a chart of the price of gold and the price of the GDX, and the gap between the two is still large and kind of stunning. And I think that's because of what I've always described in my interviews as what I call battered gold stock buyer syndrome. I mean, they did so poorly for so many years that people are very afraid of them in general. And even though, the price of the metal has gone from, 2070 where it was before it broke out in March to 2500, which is a really meaningful move, and is going to increase the profit margins of a lot of these miners. The stocks really haven't, they've gone up, but not nearly as much as they generally would. I mean, the general rule of thumb is if gold goes up 10%, the stocks go up 30, and we haven't seen that yet. And I think it's just because people are afraid of them and they're looking backwards, and backwards they haven't performed particularly well. And so that all makes sense. The other thing related to that, as you and I talked about pre-show, was, the ASICs are going up. I mean, the inflate ASIC is the all-in sustaining cost of mining an ounce. And there's inflation there, right? I mean,
Yeah,
explosive.
so let me add here for Lawrence here. Newmont Mining and Agnico Eagle both had from Q1 to Q2, their all-in sustaining costs are up about $100 an ounce. It was more surprising for Agnico Eagle, which is the lowest cost producer of the senior miners. So
Right.
Newmont's costs have been steadily rising for the last couple years, every couple quarters. I think their costs were around $1,100 an ounce in 2020 or 2021, and they're up to just under $1,600 an ounce now. But like Lawrence said, I mean, it's still, if their costs are 1,600 and the gold price is 2,500, that's still a pretty healthy profit margin.
Absolutely. No, I mean and they're going to start to really generate some serious cash flow, and generalist investors are going to see that and say, well, should I be paying 40 times cash flow for Nvidia, or should I be buying, this mining stock that's trading at 4 times cash flow? And I do have a lot of companies in my portfolio trading at 4 times cash flow. It's a 25% implied yield. So, yeah, the time is coming in that sector, but boy, oh boy, it's been hard and long, and you got to be patient here, because even I am kind of disgusted and frustrated with how long it's taken. I mean,
Well, I
you know,
mean, isn't Newmont still up about 20%? Newmont and Barrick are up about
starting
20%.
starting to move. All my portfolio is starting to move. My fund's up like 23 or 4% year to date. I mean, it's starting, right? We're going in the right direction here. That's all good. But I think we got a long way to go to kind of catch up because of that historical gap I've talked about with respect to the relative valuation of the miners compared to the metal. I mean, I still see a lot of people building their models on, and Bloomberg, as recently as a month or two ago, had the 5-year out consensus gold price was $2,000. So if you kind of think the 2,500 isn't going to hold, and in fact we're going to go back down to 2,000, and the ASICs are going up, well then the margins aren't going to be so good, right? I personally view it the other way. I don't think we're going back to 2,000. I think gold's going to 3,000, and then I think it's going to 3,500, and then etc. So a lot of it, I mean, the gold mining business is a spread business, right? It's what's the cost of the metal, what's the cost to yank it out of the ground, and when that spread is growing, the stocks do well, and when that spread is shrinking, the stocks do terribly. So it's
Yeah, unless you own royalty company shares, because if you go and look at
well,
the
that's
max
correct.
charts, so
That's correct.
post from 2010 to currently, if you go and look up the max charts of Franco-Nevada, despite Cobre Panama problems recently, or Wheaton Precious Metals or Royal Gold, those senior precious metal royalty and streaming companies, the last 13, 14 years have done very, very well.
You're correct. You're correct. They're much safer. I don't traffic in those as much because they're also much more expensive. And so I'm looking for more torque, and you get more torque in the companies that are actually taking more risk. But you're correct. Those are good places to be. That's the kind of thing. That's where I put my mother's money, right? I mean, if you want to invest in mining in a conservative way, you buy the royalty companies.
Do you think that the mid-tier gold miners, so like Alamos Gold, Lundin Gold, Kinross, IM Gold, they've been having pretty good earnings profit margins. Do you think that that's a better place than the Newmont Minings and Barrick Golds right now?
I do, because I think they've got more opportunity to grow their mines, and it's really company specific. I mean, the names that you just listed, I like some better than others, and I'm not going to necessarily say which ones, but the majors. I mean, the majors really being kind of Newmont and Barrick. I mean, they've got to find and replace north of 4 or 5 million ounces a year of production. That's hard to do, and it's hard to grow production in one of those businesses. The next tier down, like I take a Kinross, which I love. They don't have as much. That's not as big a challenge. I actually prefer to go even one tier below that, which is to say, the companies like an Eris or a B2 or the kind of companies that are in the multiple hundreds of millions slash low billion-dollar market caps. I mean, I think the market cap on Newmont and Barrick is like in the 30 to 40 billion dollar range. I mean, these are big, big companies. It's hard for a 30 or 40 billion dollar company to double or triple in value. it's not as hard for a $1 billion or a $500 million market cap company to triple in value. If they make some right moves in terms of growing production and maintaining profitability. I think the sweet spot of the gold mining business is to find somebody who's producing, somebody who has cash flow, and then a management team that you think can effectively deploy that cash flow to replace and grow that production. Because then you get the benefit of a rising stock of a rising production profile. Hopefully you'll get a benefit of a higher gold price. I mean, we're all counting on that. If the gold goes to 3,000, your margins get better. And then finally, the market's going to wake up and say, hey, you know what? These things are cheap and they really shouldn't trade at 4 times cash flow. They should trade at 8 or 12 times cash flow. Well, the cash flow cannot change at all. And if the multiple goes from 4 to 8, you've doubled your money, right? I mean,
Yep.
so so that
Everyone's
so
looking. So what you're describing is a multiple re-rating or a multiple expansion.
multiple expansion, exactly. And that's why on the right part of the cycle, these things can be so explosive to the upside. I mean, look, my fund hasn't done particularly well the last 3 years, and I'm ashamed of that, but it just is what it is. But, when we got it right in 2019, we went up 97% that year, and in 2020, I went up 122%. So, when you get into the upswing of one of these cycles, which I think we're coming into right now because we had 3 years of correction from 2020 to 2023, it tends to mean revert pretty aggressively. You know what I mean? And I feel like we're on the cusp of that happening, particularly when you consider what we talked about earlier, just the macro backdrop of, there ain't anybody around here thinking about cutting expenses or balancing the budget or behaving in a fiscally responsible manner, right? I think given that you got that going on, to me, these are going to probably be, the best performing stocks, the next 2 or 3 year cycle. I think they will vastly outperform. I mean, look, Nvidia is a good company, right? It's got great products. They're needed. AI is important. I get all of that. But, given the multiples it's trading, how's that company going to double or triple in value from here? It's going to be hard. That's a hard piece of work. You know what I mean? Whereas I've got a lot of companies that should easily double or triple in value from here.
Well, for Nvidia to go up that much, you also need all the large technology companies. So Amazon, Microsoft, Meta, and Google, you need them to invest hundreds of billions of dollars into capital expenditure to build the next generation data centers to buy all the chips that Nvidia is selling. But they also have to build these data centers out with like infrastructure, copper, nuclear power, cheap electricity. They have to build all those things first.
Absolutely. And by the way, that's a huge issue, right? I mean, you look at China, they're building 30 nuclear reactors. We're not building any, and Michael Saylor, who's very wise on these things and, big Bitcoin guy, he said to me, he said, look, we're gonna go to nuclear power. And I'll tell you why we're gonna go there, because if we want to remain competitive in AI, we need 10x the power generation capability that we have today. And there's no way you can do that with fossil fuels. You just can't get there.
And you definitely can't do it with solar and wind because it's not
No,
reliable electricity. You need cheap electricity. It has to be reliable,
exactly.
baseload, and cheap too.
Right. And this has, by the way, this has enormous implications for the uranium market, which I know Rick Rule is a big fan of, and I am too. I don't do that market just because I'm focused on the monetary metals. And I mean, really investing in mining stocks is really difficult. I mean, there are a lot of bad ones, there are a lot of bad management teams. I mean, this is a tricky area. And there are a lot of people who've lost a lot of money investing in mining stocks. I wouldn't recommend it for the average person, but
I 100% agree. And actually, I have a few more questions, Lawrence, so I want to just fire them off for you.
yeah,
We
go ahead.
wanted to talk about, red flags that we could have seen here with
Yeah.
Argonaut Gold and Mangino, SSR, Victoria Gold, that open pit mine in the Yukon. I mean, the Yukon is supposed to be safe. Canada is supposed to be safe, and yet poor Victoria Gold, they invested the entire company into one mine, and now like they're going through bankruptcy now, and some other miner is going to end up buying the asset for pennies
Yeah.
on the dollar out of
Yeah,
receivership.
I mean that's just a heartbreaking story because I know the people there. I know John McConnell. I know his wife who runs Banyan. They're good people. They're honest people. They worked hard. They built a decent mine. I mean, what makes me angry there is that some engineer really just blew the call. And I heard it was actually based on cost that the financiers pushed them hard to build the tailings or the heap leach pad that they had up on a hill because it was easier and faster and cheaper than building it down in the valley. And apparently the engineers believed and were told or whatever they calculated that it was stable if they did it in that fashion. Of course, it wasn't stable, and the failure of that pad destroyed the company. I mean, it's a bankrupt. They're in bankruptcy. So yeah, I mean it's tragic, and it's part of the difficulty of the mining business. I mean, there was nothing illegal done there, but there was something stupid done there, and perhaps stupid because of cost pressure and so forth. But because I've talked to some people who said there's no way I never would have built such a thing on a hill. But it's a very sad story, and unfortunately the environment wasn't terribly damaged. And my guess is out of bankruptcy there will be a mine there. There's a lot of gold there, and if they build the pad down in the base of the valley, they can probably restart it. But it'll be some new company. It won't be Victoria. The other thing is we talked about pre-show. Victoria's got a really beautiful asset sitting 30 miles to the east of their main mine called Raven, which is a very, very high quality deposit and actually higher grade than their existing mine and could easily be turned into a mine. And so what we'll all do is we'll watch and see. I mean, out of the bankruptcy court, probably somebody will buy the Raven asset, and that'll actually be a pretty good investment. But my fund owned Victoria. I believed in it, and it's part of the game. I mean, sadly, it was a pretty small weighting in my fund. It was like 1.5%. And I sold it, the minute I heard the bad news, I sold it. And, I think I captured maybe 25% of that because it went down quite a bit. It went down 80% overnight, and I sold it instantly, and now it's gone to zero. But
Well, they were issuing in press releases over the last month before they went into bankruptcy and receivership with the court and with the accounting firm PwC that's in charge of selling off the assets. They've been warning for, I think, the last month that their creditors were going to call on the loans and found them in default. So anyone who was holding on to the shares should have read the press release and seen the last sentence. It was the last sentence of every press release for the
I
last
mean,
month or so.
and look, any good financial analyst, the minute you heard that, you looked at the picture, you looked at the debt they had, and you just realized that this thing's toast. I mean, there was no way, absolutely zero. I mean, the Yukon is going to go after them for environmental charges. I mean, there's hundreds of millions of dollars that needs to be spent to make that mine right, if it can be done. And the creditors all have a first claim on those assets. So Raven will get sold, and whoever buys it will pay the creditors, and so the creditors will get some of their debt back. But yeah, it's a mess. It's very sad, and I mean, it's the reason why, you never buy one gold miner, right? I mean, I've got over 90 names in my fund. Okay, now some of them that I really like might be as high as a 3 or 4% weighting, but I never get much higher than that because, you just never know, right? Things can go wrong in any company.
We'll
So.
look at SSR with Chopler, and they also had I think it was a mudslides at their open pit mine heap leach, and they're looking at least $300 million in
Yep.
reclamation fees, environmental fines, and settling lawsuits for wrongful death. So, and that
Similar.
was.
Very similar. I did not own SSR. For just I had heard things about them that led me to not have any of that. So I dodged that bullet. But yeah, that's part of the game. I mean, the flip of that, just to give you the full picture, is that when these things do work, I mean, so you can lose 1x, right? I mean, I'm just describing asymmetry. You can lose what you invest, but some of these companies are good when you buy them. They're small, they're growing. I mean, you're looking at not just making 2x, you're looking at making 3, 4, 5, 6, 7x. So, if every now and then, if 10% of them or even 20% of them go BK and you lose it, fine. If the ones that work give you 5x, you're still way ahead. And that's really the way that this industry has to be approached.
I want to ask you about mergers and acquisitions because we did have a large deal in the last couple of weeks. Goldfields, which was, I think, a 50% joint venture partner with Osisko Mining for the Windfall mine in Quebec. They took out the entire project and I think the land package around there. They assumed then the deal with Bonterra Gold, which owns all the land around the Windfall mine. Do you think that we're going to see a lot more similar deals to that, to what Goldfields did, where like a mid-tier miner is?
Absolutely. I mean, and by the way, that's a fabulous project. I owned a Cisco way back in the day, and that particular mine, that's going to be a really, really big world-class mine that's going to run for years. I mean, Goldfield's got a great asset there. But yes, to answer your question of are there going to be deals? Absolutely. I mean, if these miners were a little bit smarter, they'd be doing them right now if things are still cheap. Although they probably know that if they go to some of these boards, the boards are going to say, no way. We're not selling out for a 30% premium given what we know is coming. But yes, I mean, keep in mind that the large miners have a continual need to replace what they mine. and they've underspent. I mean, Tavi Costa on Twitter has great charts on this, and he puts them up on a regular basis, showing, expenditures and capex that's been spent to try to increase reserves, and we've underinvested in this industry for 10 years now. And so, as these prices go higher, these big companies, these big, miners are going to realize, oh my God, I don't have enough projects in the pipeline. I need to go buy some. And that's my portfolio is full of those companies. I mean, little companies. I mean, I'm on the board of one that I love called Cabral. It's in Brazil. They've got just an enormous asset, in my opinion. And I'm quite sure that somebody's going to need, is going to want it, and they're going to come and pay multiples of what it's worth today. And there are a lot of these situations out there. I mean, the companies that have made it through, this tough 3, 4 years, they've made it because they have something. And I mean, that's the nice thing about these miners. I mean, is that, I mean, yes, if they're not producing, they have negative cash flow, but the gold doesn't go anywhere. I mean, if you've got 1 million ounces in the ground, at today's prices, what's that worth? $2.5 billion. I mean, now you got to get it out of the ground, but it's 2,500 times a million. So it's a big number. And I've got companies, lots of companies that are trading for, $10 per ounce in the ground. And, when that ounce, once it's pulled out, is worth 2,500. I mean, that's a pretty good margin. Now, to be totally fair, it takes capex, time, and expense to pull those ounces out. But in prior acquisition cycles, we've seen ounces in the ground sell for $100 or $200 per ounce in the ground, and I've got companies selling at $10 per ounce in the ground. So
So do you target then the Lassonde curve then, where these companies, you're looking
yes,
for specific companies in that Lassonde curve there, which is a chart that Pierre Lassonde initially came up with, and I think Brent Cook and Lobo Tigre also use, where the company has raised all the capital to build the mine. The market is skeptical about the mine coming in on time and on budget. The construction's almost done with the mine, and then all of a sudden the mine just starts becoming a cash flow machine.
yeah, I mean, there are lots of places among the Lassonde curve to invest. I mean, there's early exploration when they're growing their resource very rapidly. I'm involved with one of those called Lavras, which I think is an enormous resource, and it's growing. I'm on the board of that as well. And Cabral fits into that. They're still growing their resource very rapidly. But yes, I mean, from the time at which you have a very large resource to the time at which you're pulling gold out of the ground is generally 5 years at least. And so, that can be a bad time to own a gold stock, unless you're in an acquisition cycle, in which case a bigger company is going to come in and pay you for what you have in the ground. But yeah, and so the developers, what you were describing, the companies that have, they've gone through the permitting process, they've done the PEAs and all the work, and they've got maybe a full feasibility study, and they're looking to finance it. Those are a very interesting place to play, but they're tricky because, as I mean, things don't come in on time. You mentioned Maginot earlier. I mean, Maginot got Argonaut in a lot of trouble, and Argonaut had to sell out because it cost more and took longer. So
They were a one asset producer though, right? So this
no, no,
wasn't
no.
like,
They had tired assets in Mexico that were making money. Not a lot of money, but they were making money. But yeah, but I mean, and the guy who ran it was a world-class guy, Richard Young. But he basically realized that, what, this is just too big a lift for me to do alone. I'm gonna team up, and so he sold.
okay, so that makes sense. So they had a scaling issue then. So they had run successfully smaller, older mines, and then they tried to buy a larger mine and build a larger mine on their own, and they
Exactly.
had problems
And
with the scaling.
that's exactly right. And look, I mean, the guys who can bring in a mine on time and under budget, they're pretty rare. It's pretty hard. I mean, the marathon guys up in Newfoundland are having that issue right now. I think they're going to get it done. I mean, Ascot's had some of that problem. I think they're going to get it done too. But I mean, this is not easy. I mean, it's not easy to go from, we know there are a bunch of ounces there to I've got ounces coming out of the factory, out of the mill. I mean, there's a lot of slip between the cup and the lip in
Oh
that
yeah.
in that
It
process, right?
well, I mean the Lundin Mining, Lundin Gold, the Lundin family has a pretty good track record
They
of
sure
bringing
do.
mines in
They,
on
they
time and
They do. They are world class at it. And these guys who just did G mining, I mean, they did a world class build down in Brazil, and I mean that's a very high quality company, and they're pouring gold now, and arguably, I mean, personally, I think they're going to have to buy Cabral because their reserves aren't long enough, and Cabral's 10 kilometers away, and we've got these enormous reserves. So, but yeah, that's right. I mean, there are some people who are better than others at doing it, and even having said that, as I say, I mean the management team at Victoria they were not bad people. They weren't. I mean, they were good people. They were honest people. They tried hard. They just made a mistake. I mean, some engineer made a mistake in saying that this thing could be built on a hill and be stable. That
It
was
sounds like, well, it sounds like they were pressured. It sounds like the
well, that's
financiers said, come up with a cost, a benefit budget solution to reduce the cost of
I,
building the mine
I,
by
I,
50 million or 100 million or
I
something.
certainly think that's a part of it. I certainly think that's right. And guess what? I mean, when you let financial people drive your engineering decisions, that's a recipe for disaster, as we just saw, right? So.
In your opinion, are we at a gold price now where you think some of your juniors are going to actually be able, maybe with a joint venture partner similar to the Osisko Mining and Goldfields deal, where they're going to say, we're going to raise all the capital in the next 6, 12, 18 months, and we're going to go build mines? Are we at that stage of the cycle right now?
Do think we are, and I think it's case by case. I think some of them are literally just drilling to find a big resource, and they don't have any plan to develop it, and they'll sell it. I look at Cabral. I mean, so that it's interesting, and it somewhat goes, Jason, to the scale. The bigger the project, the more you either need a partner or it's hard to go it alone because it's hard to raise hundreds and hundreds of millions of dollars. I mean, I go back to the Cabral case. I know it well because I'm on the board. They're talking, and I like companies that do this, by the way. They're talking about doing kind of a small starter project, where for a modest capex, call it 30 million or less, they can get into production and start to generate cash flow. And then, what they'll do is they'll use that cash flow to expand and, increase production over the years. So there are companies like that that can quote unquote bootstrap themselves. But there are other drill stories where you just know that the mine is so large and so capital intensive that you're really just playing for, we just want to find a ton of ounces and then somebody big is going to have to come buy it and build it because we can't build this. I mean, it, you know, it is hard to raise tons and tons of money for a mine build. It really is. And the good thing, what the big companies do have that the little companies don't, and this is the arbitrage, is they have good balance, not always, but in many cases, they have good balance sheets. I mean, if you're Newmont or Barrick or one of these big companies, I mean, you can go and raise, 500 million of debt. You can go and do an equity shelf deal and raise $100 million. If you're a dinky little company, you can't do that, right?
Without destroying the amount of shares
That's right.
issued, or
You're
basically
gonna
betting
shit
the
on
whole company on the rise and failure of the one mine. You have to basically
that.
like
Right.
Victoria Gold.
It's just too risky. It's impossible to do. Yeah.
And that's the issue you run. So I think like the Osisko mining model there in Quebec with Windfall, I mean, it was a 50-50 joint venture. I know they were heavily criticized for doing a deal like that, but there was like the downside risk, the bankruptcy risk was very, very low. And that mine is going to get developed, potentially could turn into a district because there's other satellite deposits next door for Bonterra resources. And that's why that junior has been doing well lately.
Correct. I mean, that's exactly right. And I mean, it's yeah, that's right. That's a very good description of it.
Yeah, I think overall the joint venture, I know it's criticized the 50-50 joint venture deal, but I mean, it limits the amount of equity dilution and then the miner doesn't have to bet the whole company and you don't get the risk where like the company Victoria Gold, if the mine doesn't come in on time and on budget, or there's an issue there with the heap leach pad where the company goes bankrupt. So I think the 50-50 joint
I'm
venture
with you.
deal.
And I like that JV approach. And by the way, we were in Osisko before Goldfields came in, and we made money on it as a result of that deal. So yes, I mean it was. I mean, I was a little disappointed because I actually thought the team there was good enough that they could build it and take it on their own, and we would have made more money if they'd done that. But it kind of came down to a one in the hand, two in the bush. And look, anytime you make a profit on a mining investment, that's a good deal.
Now, last question here. I want to ask you about the elections and the results here in Colombia, in Mexico. It seems that a lot of the politicians that are getting elected lately at the tops of these governments, they've come out and said that mining is bad for the environment. Any type of open pit copper and gold mining damages the water, the soil, the air, all around the mine. Do you think that there's going to be a lack of supply going forward in these countries that used to produce a lot of copper, gold, and silver, and that either the permits will be delayed for many, many years, be very expensive, or outright withheld?
That's a great question, and it's case by case. I'm actually pretty bullish on Colombia. I don't think they've got a serious issue there, and I think they will continue to mine. I mean, look, and rightly and fairly so, everybody concerned in the mining business and everybody concerned in the government that's regulating the mining business should make the mining business be clean and responsible and, do a good job of taking care of the environment and reclamation and all that stuff. I mean, I don't think any smart miner has any objection to any of that kind of regulation. And that's just kind of world-class standards and it's being implemented in lots of places. Let's go to the Mexico example because it's very timely and with this new Claudia, I think it's Scheinbaum, I may have her name wrong, but Shine something or other. Anyway, she, coming in and talking, they're talking about what they're going to do with the concessions and whether they're going to issue any new mining licenses. And there's two steps. I mean, one, you get a concession and then you get a license. And the talk I heard was that they're not going to issue any new concessions, which, I mean, companies like Discovery, which is a company that I own, that I believe in, that I think is a very good company that's got an enormous deposit, would be a great mine. They have a concession. That's not an issue. If they ban new concessions, that's not a problem for Discovery. What they're trying to do is they're trying to get a permit. And it has to do with the Senate and the House in Mexico, and the people are counting the votes and all this other stuff. Here's my bottom line on it. I can't say for certain whether open pit mining will get banned in Mexico. I probably rate it as a 80-20. It will not get banned. I think there's some possibility of it. You've got to remember that at the end of the day, governments are greedy. Governments want money. Governments want royalties. Governments want profit, and governments want their people to have places where they can go to work. And mining employs a ton of people in Mexico, and the place where the Discovery Mine is located is a very mining friendly region with total support of all the governors and the mayors and the people there. I mean, they want the jobs. So I mean, a lot of people said Discovery took a big hit recently in terms of the stock price when all this talk of banning mining came out, open pit mining came out. And my view was I actually didn't want to sell into it. And in fact, we've been buying into it lightly, but nibbling at it because, the market was acting as though they're definitely going to ban open pit mining and this will never get built.
Yeah, I mean, I think it could also be a renegotiation where the government says, okay, we're going to delay the permits for a certain amount of years and you have to pay the government higher fees for the permits. Because
Absolutely.
didn't they do that? Correct me if I'm wrong. If I remember correctly, a year or two ago, maybe 18 months, something like 24 months ago, the same thing happened with the San Jose silver mine that Fortuna Gold and Silver had that was already producing. They had their environmental permits pulled temporarily and they had to pay a larger amount to the
That's
government to get the restart.
You know your facts. That's exactly right. And look, I mean, governments are greedy, and so, but the mine that Discovery is looking to build is so big, so valuable. I mean, it'd be worth billions and billions of dollars. The market cap on the company today is a couple $100 million. That if the government takes a slightly sweeter deal, okay, I mean, that's not great, but it doesn't mean they're not going to get it built and get it done. So. Look, this is just the nature of this business. You're always just trying to assess risk versus reward. How cheap is it? What would it be worth, under good conditions? What are the odds of those good conditions? Okay. Is there some chance that that they ban it and it doesn't get built? Yeah, there's some. And in that case, the stock would go down. Although, and I'm going to be going to the shows to see the Beaver Creek in Denver, and I'll be meeting with these companies. But there's some possibility that Discovery could repurpose what they've got, and part of it could be they could do a smaller version of what they're doing in underground. I don't know if that's true or not. I want to investigate that. But the point is that it's in my view, there's enough upside to justify taking the risk that they do not get the permit, and the downside scenario unfolds.
Yeah, with Endeavor Silver, you also have the Pizzeria project. I think they
Yeah.
bought in the last. That's a massive silver
Oh,
deposit, but it needs
that's a
like
beauty. Yeah.
it's like 300 million ounces of silver reserves. Silver Standard used to own it years ago, and then they converted to SSR, and they decided they didn't want to develop it. I think it's like it needs at least I'd say $35 an ounce silver. It was discovered in like 2010 or 11, so it's a massive deposit there. I think it's open pit mining too. So I don't know what it is with the permit situation, but Endeavor Silver shares haven't been doing well. Lawrence, does it seem like in terms of countries that are safer now, Argentina, Ecuador, Canada, that's where the mining companies tend to be investing now with deals with royalty companies tending to fund new mines and other mergers and acquisitions? Do those companies seem safer now where the capital is flowing to for the mining industry?
I think they do. I mean, I'm pretty, there are certain countries that concern me, but the ones you just mentioned don't in general. I mean, having said all of that, I mean, I will say just, I mean, and Rick Rule always makes this point that there is no safe jurisdiction because governments are greedy. I mean, that's one of the problems. I mean, I think all of these, all of these governments, as this stuff starts to become more profitable, and as governments have larger and larger deficits, they're gonna show up with their hands out. Do you know what I mean? And that's, but so you just got to factor that into the math that you do when you calculate what the upside and the downside are.
And that's why it's easier as a royalty company. You own the senior royalty companies or the mid-tier ones, and you buy it at the right valuation. I mean, I think Osisko Gold royalty shares for listeners out there, it got hit on the Victoria Gold because they had a royalty on that, so it got hit. I think it got down to around $15 a share. If it drops back down to around 15 a share, I'm going to start to look at maybe nibbling at it again on weakness.
Yeah, that sounds intelligent. Yeah, I mean it's a tough business, but when if you get it at the right part of the cycle, and I think our conversation is timely because in my opinion, we are finally coming into the right part of the cycle. I mean, if you look at any of Tavi's charts, my charts, I don't know, Grady on Twitter, he has some very good charts. I mean, these things are cheap and they're breaking out. And the monetary chaos that the Fed is giving us is only going to get worse. And as it does, these things are going to perform well. I mean, I fully expect my fund to go up, multiples. I mean, 2, 3x in the next 3, 4 years.
Well,
So
I think the probability, I don't know if it's 100%, but I think the probability is pretty high that we see $3,000 an ounce gold in the next 18 months or less based on the central bank buying and how China and Japan, the largest holders of US treasuries in the past, they're not buying treasuries anymore. They are now net sellers of treasuries lately. So it looks like there's going to be more dollar devaluation, debt monetization of some sort, Fed balance sheet expansion. And the demand for gold, it's not coming from the West right now. Retail investors, the majority of it's all out of Asia, and that's what's been fueling the price. So I think we could see potentially $3,000 gold in under 2 years going forward, maybe even under 18 months.
I completely agree with you. I mean, I completely agree with you. I think that it's Michael Oliver is a good technical analyst that I follow and use, and his view is that we are now entering "quote unquote" the acceleration phase in this marketplace, and I think he's right. We've got the world is waking up to the fiscal and monetary situation that we're in. That's my belief, and as that waking up continues, I mean, let's still consider that, I mean, there's $900 trillion of financial assets in the world. There's 12 trillion of gold, and probably a third of that's not really tradable. It's in museums or central bank vaults. There's probably less than a trillion of total gold stocks, gold mining equities. And so as some of that 900 trillion of financial assets, particularly the bond piece, realizes, oh my God, inflation's not going down. It's real. It's getting worse. It's going to look like the 70s. I've got to find protection. And they're going to go, and they're going to go for the gold, and they're going to go for the gold miners. And some will
Well,
go for the more younger ones, probably go for Bitcoin. But I mean, just because these are things that protect you against monetary debasement. And I think the mistake most investors are making is they've seen a 40-year deflationary environment from 1980 to 2020. And they're thinking to themselves, we're going back to that. Yeah, we've had this blip. It's all based on COVID. That'll go away. We'll be fine. We're going back. And I disagree. I think that, the fiscal situation that we're in means we can't go back to that we're going to continue to print and that we've actually entered an inflationary cycle, which, at some point will end, but we're in the early innings of that inflationary cycle, in my opinion.
and
We
it's
just,
not just the US, it's looking like Japan and
all,
China, the European Central
all of
Bank,
them,
Bank of England, all
all of
these
them.
governments and central banks, they're running enormous budget deficits, and the central banks are about to start debt monetization, some type of financial repression or yield curve control, and trying to bail out their banks.
All of them. You're absolutely right. I mean, it's a worldwide problem. I mean, there's a large sovereign debt bubble, and when you have a large sovereign debt bubble, I mean, we haven't seen it at a world reserve currency level since Rome, but I mean, we know, read Dalio, read his book on, his debt crises book. I mean, we have hundreds of examples of countries that have run up too much debt. They get to the point where they can't afford to pay the interest on it. The deficits continue to grow, and it becomes a doom loop. And they just, something has to give. I mean, either there has to be very high inflation to reduce the debt relative to the size of the economy, or, the debt's going to collapse. And you're going to have a 1929, 1930 depression-like thing. And I know the Fed is aware of that, and so I'm quite sure they don't want to have the 30s repeat themselves. And so, they will do everything they can to print the money necessary to keep the system going, which will keep the system going. That's the good news. The bad news is it'll be inflationary. The release valve will be inflation.
Yep. And do you remember when Brent Johnson was a gold fund manager before he switched to the dollar milkshake theory? He used to say, if you believe in math, buy gold. So, I mean, it's looking like now, many years later, things are starting to play out.
That's right. I mean, he's where we are. I think the thing that's different about Brent is he kind of believes that we're too early in that this is going to be a multi-decade kind of thing. And I differ with him on that. It's here and now. I mean, go look at a chart of the US interest expense, right? I mean, it's going parabolic.
Well, I think the dollar milkshake, the dollar milkshake is a rear view mirror thing. So I think he accurately described what happened post 2008. Because I mean, like, anecdotally, I have friends who are real estate agents who used to have Chinese clients fly in here, and 48 hours they would have bought some properties and be back on a plane flying to mainland China with cashier's checks or a briefcase of cash and stuff. So that was going on from 2009 to like 2019. So that was going on for a decade or more.
That's right. He had it right, but I think he is looking in the rearview mirror. And I think, look, in 2020, we hit peak deflation. The 10-year traded at 50 bips for a brief period of time. And ever since then, it's gone the other direction. And, to me, that's the story, that we no longer live in a deflationary world. But it's hard for people who've had 40 years of something to admit or accept that the trend has changed. And yet, looking at all the charts, looking at all the data, thinking about how we got to that peak deflation. I mean, how we had negative interest rates, right? I mean, it was crazy. The trend has clearly changed, and we now live in an inflationary world. And so everybody who's been an investor for the past 10, 20 years has to kind of relearn or think through, the playbook that they've used, because it's not going to be a successful playbook if the conditions are different. And I think they are different.
Yeah, I think it's very different.
I mean, everyone says, I'm saying it's different this time, and I get it. A lot of people say, no, it's not. It's been this way for 40 years. You're wrong. So, I mean, we're going to see. Somebody's going to be right here.
40 years ago, there wasn't a derivatives market, though. So, I mean, like, the banks weren't doing a lot of the large banks, Lawrence, they don't make their profits from normal lending like a bank used to. They made their profits with like hedge fund trades.
Exactly. No, it's all changed. It's absolutely all changed. But hey, I've got to wrap, Jason, just because I've got another commitment. We've gone a little longer than I thought.
Yeah, I really enjoyed our discussion today, Lawrence.
I did too. I hope you don't mind, but I've made a commitment that I've got to go live up to. So to have dinner with my wife. So thank you very much, and I'm happy to come back in the future. And you obviously get this stuff very, very well, which is why I enjoy talking to you.
And we'll put a link to Lawrence's Twitter or X bio, and also Equity Management Associates link.
Yeah, and I do publish a newsletter every quarter. My partner and I, David Foley, and I publish a newsletter. We manage two funds. We manage the EMA fund, which does gold and a little bit of Bitcoin, mostly gold and gold stocks. And we also manage Bitcoin Opportunity Fund, which David, in fact, we're about to raise another round of that. So if anyone has interest in that, reach out to David or myself.